Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the financial mumbo jumbo. Today we're diving deep into the Hawaiian Tax Free Trust latest report, and let me tell you, it has got some juicy financial details hidden within those numbers. If you like getting straight to the point and understanding what these reports really mean for your money, make sure you are subscribed and join our Discord community, linked down below. So what is this Hawaiian Tax Free Trust all about? Basically, it is an investment company that focuses on municipal bonds, meaning it invests in bonds issued by governments to fund public projects like schools, highways, and hospitals. The big draw here is that the interest earned on these bonds is often free from federal, and in this case, Hawaii state income taxes. This makes it attractive for investors looking for tax-advantaged income. This report covers the period up to the 30th of September 2025. We're going to cut through all the legalese and get to the heart of what is happening with their investments, their costs, and their overall financial health. First up, let's talk about the size of the operation. The trust has substantial net assets, standing at a whopping $383 million as of the 30th of September 2025. That is a lot of money being managed, and it tells us this is a significant player in its niche. Now, for the really interesting part where the trust is putting all that money, they've provided a breakdown by credit quality. Think of credit quality as a measure of how likely it is that the bond issuer will pay back their debt. The higher the rating, the safer the investment. A big chunk of their holdings, 4.2%, is in AAA rated securities. This is the highest possible rating, meaning these are considered extremely safe bets. They also have a substantial 32.8% in AAI rated securities. This is also very high quality, just a notch below AAA. Another large portion, 31.3%, is in AA rated securities. Again, very solid investments. And 24.8% is in AA rated securities. So you can see a clear pattern here, a heavy concentration in highly rated secure municipal bonds. They do have a small portion, just 0.7%, in BBBY rated securities. These are still considered investment grade, meaning they are reasonably safe, but they carry a bit more risk than the higher ratings. They also hold 1.1% in cash, which is standard practice for liquidity and to manage fund operations. So overall, the portfolio is heavily tilted towards safety and security, which makes sense for a tax-free trust aiming to preserve capital. Let's dig into the actual investments. This is where we see the specific bonds they hold. We see investments in Hawaii County general obligation bonds with varying interest rates and maturity dates. For example, there is a bond with a 5.00% interest rate maturing in 2046. There are also revenue bonds from the Hawaii Housing Finance and Development Corporation, some of which are puttable, meaning the bondholder can sell them back to the issuer under certain conditions. We also see a sizable investment in Hawaii State Airport System revenue bonds. These are important for funding infrastructure. Looking at the total, the trust has invested a massive $377 million in municipal bonds, with a current value of over $375 million. This shows a very slight difference between cost and current value, suggesting the portfolio has been relatively stable in its valuation. Moving on to the balance sheet, the statement of assets and liabilities gives us a snapshot of what the trust owns and what it owes. Their investments are valued at over $379 million, with a cost of about $381 million. Again, a very small difference. They have accrued interest receivables of over $4.4 million, which is income earned but not yet received. This is a significant amount, highlighting the income-generating nature of their bond portfolio. Their total assets are just over $384 million. On the other side, their total liabilities are relatively small, just under $1 million, mainly consisting of various operational payables like fees and distributions. This brings us to their net assets, which is the value of the trust after deducting liabilities. It stands at a healthy $383 million. Now let's look at the statement of operations, which shows us how the trust performed financially over the reporting period. The trust generated over $6.6 million in interest income. This is the primary driver of returns for a bond fund. They also received about $258,000 in dividends, likely from any equity holdings or other income sources. So their total income from investments was nearly $6.9 million. Of course, managing all these investments comes with costs. The advisory fees paid to the investment manager were around $445,000. This is a significant expense, but it is typical for investment funds. There are also distribution fees, especially for Class A shares, totaling over $350,000. These fees are related to marketing and selling the fund shares. Their total expenses for the 6 months were about $1.7 million. After deducting expenses, they had a net investment income of over $5.1 million. This is the pure profit from their investments before considering market gains or losses. Interestingly, they recorded a net realized loss from investments of about $4.3 million. This means they sold some investments for less than they paid for them. However, their investments that they still hold are worth more than they originally paid, showing an unrealized appreciation of nearly $10 million. So, when you combine the realized losses with the unrealized gains, the trust saw a net gain from investments of over $5.6 million. This leads to a total increase in net assets from operations of over $10.7 million for the 6-month period. That's a solid performance, especially considering the realized losses. The statements of changes in net assets shows us the movement of the fund's assets over time, as we saw operations brought in over $10.7 million. Then, they paid out dividends and distributions to shareholders. In total, they distributed over $5.1 million to shareholders. This is how investors get their tax-free income. A significant factor is the decrease from capital share transactions, which means more money was withdrawn by investors than was invested through new sales of shares. This outflow was nearly $20 million. When you put it all together, there was a net decrease in the trust's assets of about $14 million for the period. This is primarily due to share redemptions outweighing new investments. Now let's look at the per share data, which gives us a clearer picture of individual investor performance. We'll focus on class of shares here, as they are quite common. At the start of the reporting period, the net asset value, or NAV, per S-share for Class A was $10.4. They generated about 14 cents per S-share in net investment income, and they saw a gain of about 16 cents per S-share from the change in the value of their investments. So, from operations, the per share increase was 30 cents. They paid out 14 cents per S-share in dividends. By the end of the period, the NAV per S-share rose to $10.56. This resulted in a total investment return of 2.89% for the 6-month period. That is a pretty good return, especially considering it is tax-free income. The expense ratio for class of shares, which is how much it costs to manage your investment each year, is 0.91%. This is a reasonable expense ratio for a specialized municipal bond fund. The portfolio turnover rate is 27%. This means that about 27% of their holdings were bought and sold during the period. This is a moderate turnover, suggesting they are actively managing the portfolio but not excessively trading. The notes to the financial statements provide crucial context and explanations. Here we learn that the trust is a non-diversified, open-end investment company. Non-diversified means it can concentrate its investments in a particular sector or geography, which we've already seen with its focus on Hawaii municipal bonds. They explain their valuation process for municipal securities, relying on pricing services. This is important because municipal bonds can sometimes be harder to value than highly traded stocks. They also get into fair value measurements, categorizing investments based on how easy it is to get their price. Level 1 is for easily priced things like actively traded stocks. Level 2 for things with observable inputs like interest rates, and Level 3 for things that are harder to price and rely more on the fund manager's judgment. The good news is that their municipal bonds are primarily classified as Level 2 assets. This means their value is based on observable market data, not just the fund manager's guesswork, which adds to their reliability. They detail how they record transactions, income, and expenses, and how they allocate them across different share classes. This section clarifies how dividends are paid out, which is a key benefit for investors seeking regular income. Crucially, they state that they do not make provisions for us income taxes because they intend to qualify as a regulated investment company, meaning the trust itself avoids paying federal income taxes. The tax benefits are passed on to the shareholders. This is a really important disclosure. The trust admits it is more susceptible to factors adversely affecting issuers of Hawaii municipal securities than is a municipal bond fund that is not concentrated to the same extent. Basically, if Hawaii's economy takes a hit, the trust investments could be significantly impacted because so much of it is tied to that specific region. They also discuss the general risks of debt investments, like issuers not being able to pay back their loans or interest. They mention that lower rated bonds, like those with a Bay rating or lower from Moody's, are especially risky during uncertain economic times. This part covers a lot of the procedural and governance aspects. Here, the trustees explain why they renewed the investment advisory contract with the Bank of Hawaii Asset Management Group. They looked at the nature and quality of services, the fund's performance, fees, expenses, and profitability of the advisor. They compare the trust performance to benchmarks like the Bloomberg Municipal Bond Index and the Bloomberg Hawaii Municipal Bond Index. It is interesting to note that while the trust performed better than the benchmark over 1 year, it lagged over longer periods. They acknowledge that the benchmark doesn't reflect fees and expenses, which is a valid point. They also compared advisory fees and expenses to peer groups, finding that the trust's advisory fee was in the most favorable quintile, meaning it was on the lower end compared to similar funds. However, the total expenses for classes shares were higher than the median. This highlights a common trade-off. Lower advisory fees can sometimes come with higher overall expenses. So, what is the story here? The Hawaiian Tax-Free Trust is a very conservative fund, heavily invested in high-quality municipal bonds primarily from Hawaii. This strategy offers attractive tax-free income, but it comes with a concentrated risk tied to the Hawaiian economy. The fund's performance has been decent, showing a positive total return for the period, but it has faced some headwinds with realized losses and has seen net outflows of assets, meaning more investors cashed out than invested in. The trustees are actively overseeing these aspects, ensuring fees are reasonable relative to services and considering performance against benchmarks. The key takeaway is that if you are an investor in Hawaii looking for tax-efficient income, this fund offers a straightforward way to get it, but you need to be comfortable with the concentration risk and the current trend of net outflows. It is not a get-rich-quick scheme, but a steady income play with tax advantages. Alright, that is our breakdown of the Hawaiian Tax-Free Trust report. What is your take on these numbers and what they signal for the company's future? Do you invest in municipal bonds, and how do you manage risk? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description to keep the conversation going. Thanks for watching, see you next time.